which goes over more than one period. But here in management accounting, we focus on one period. We will discuss the concept of the return on investment, and we will discuss the residual income concept. And the specific form of the residual income concept is the economic value added, which hopefully we can discuss at the end of this lectures. And we'll ask also what is more important, return on investment or residual income. Next lecture we'll discuss working capital management, which is a part of value-based management, but which has also specific aspects. And we have also a case included to that subject. We can do that either next one, or the lecture after Christmas. So there are some steps to be considered when it comes to performance measurement.
Professor,
first of all,
I'm sorry to interrupt you. I'm not sure if you have shared the screen, but we don't see it.
Oh, sorry. Thank you for telling. How about now?
Yes.
Yes. Thanks so much, Valmira. I thought I have shared it, but yes, now it works. Yeah, it's about to choose a performance measure, a KPI. It's about to choose a specific measurement of KPIs. We will discuss that later on. There are no rules for internal performance measures, so it's about each and every company can use their own KPIs, and they do. So please be prepared in practice that there are several ways to define KPIs, even if they have the same name. And when you have defined the KPIs and when you have defined the measurement, then it's about to choose a target level. This is basically what you do in budgeting. And the question is for what is the period also for that. I have an example, which is a company which runs hotels in England, London, Manchester, and Birmingham. And here you have the basic data. You have these data as well in the Excel file. The first question is, what is the most profitable hotel of these three? London, Manchester, Birmingham. In the last line, you see operating profit for London is 216. For Birmingham, it's 702 British pounds. So, which one is more profitable? Yeah, it's difficult to discuss that here. But let's go to the full screen again. If you see that, which of the hotel is more profitable? Birmingham, London? Yeah, please. Zoom works for interactive discussions, like in a real lecture. Stephanie, what do you think?
According to the operating profit, I would say Birmingham.
Yeah, which is a fact. Birmingham has the highest operating profit. But is it the most profitable one, Christy?
Maybe I suppose we should do like a ratio. So the ratio of our operating profit over the total revenue, and then we can discuss which one is the most profitable.
You would use return on sales. Okay. Any other idea? So because what we see here is that Birmingham, of course, has the highest amount of revenues too. And the question is, are there any other opinions about how to measure performance? No? No, I can't believe that. all done your bachelor studies, what have you used as most important performance measure in your bachelor studies? Aram, any idea?
Usually they use some return on equity, return on asset.
So there is return on equity and return on asset. What we have here in our example is that we did not allocate equity to the hotels, because equity is for the full company, and we did not allocate long-term debts, and we did not allocate equity. But okay, there is this return on asset issue. So let's go to our Excel file, and I'll share the screen, hopefully. Can you see that right now?
Yes.
We have the basic data, and return on asset, by the way, and return on investment are synonyms, more or less. So what Aram has proposed is to use the ROI, and there are two ways to calculate the ROI. The first one is to take operating profit over total assets. So for London, this is 24%, and for Manchester, 18.6%, and for Birmingham, it is done in a second. Oh, this is obviously wrong. So 12.54%. What you see here is that the picture changes. So the hotel which seems to be the most profitable one was Birmingham, based on operating profit, but they had the highest investment. And what you see here is that based on return on investment, the smallest hotel, which is London, is the most profitable one. I'd like to show you different ways of calculating return on investment. There is an alternative way which considers that short-term liabilities are supposed to be non-interest bearing. And the idea is to make a ratio between profit and interest-bearing capital. So what we alternatively could do is to build a ratio. It's over operating profit over total assets minus current liabilities. If you consider this way of calculating the ratio, the numbers will be slightly higher, of course, because the denominator is slightly lower, depending on the current liabilities. But the sequence regarding profitability does not change. So return on investment. And I'd like to go back to our, can you see now the PowerPoint again, or?
No, we still see the Excel.
You see the Excel? So I'd like to go back to the PowerPoint. Yeah, here we have some explanations, and these are the results, what we have calculated right now. And I'd like to introduce the so-called Dupont scheme for calculating return on investment or return on assets. And what you see here, you can deconstruct this formula. This means return on investment would be the product of investment turnover times return on sale. while investment turnover is revenues over total assets or total investments, and return on sales is profit over revenues. And the interesting thing is that this basic formula gives you an idea about the value drivers of your profitability, of the return on investment. You can do that in different ways. Here you have one way, it's done also, profit is derived from contribution margin and fixed cost. Of course, you could do that also for revenues and any other kind of cost. You can do that in different ways. But what you see here is that you can trace the profitability which is measured based on return on investment on specific items. All the assets which are considered in the investment and all the revenues and cost which are considered in the profit number. So let's go back to our Excel and try to calculate that. So we have the return on sales, which is profit over revenues,